2020 marked an incredible year in the global financial markets. In fact, more people joined in as stock market investors in this year than in any other year since the first formal stock exchange began in 1653. And what we saw was an amazing cocktail of circumstances coincide to create a set of financial conditions that we have never seen before. The global economic community are truly an uncharted territory, in that we have no data, no past trends or information to analyze and to study, to try and figure out what happens when you yank interest rates down to zero, print an unprecedented amount of money and then spend that directly into the economy. Meanwhile, half of the world was off of work, factories were closed, mines and other raw material producers stopped producing, and people had a lot of spare time on their hands. And unlike the 2008 financial crisis, where a lack of liquidity and a widespread inability to borrow money were actually primary causes of collapsing asset prices, this time around in many countries, especially in the USA and the UK, government stepped in very quickly and provided a range of grants and loans to both individuals and corporations to ensure that there was enough money in the system to keep things flowing smoothly. And they also offered additional financial aids like mortgage holidays, eviction moratoriums for renters, and job retention incentive schemes for employers. And this meant that for the first time in history we had a global recession where at the same time many people in economically developed countries were still getting the same amount of money in wages because of government aid, and businesses were given grants to cover lost profits, and in fact many people were actually saving money because they weren't spending on commutes and they weren't buying expensive lunches in the city. And they also weren't going on holidays or doing very much else at all. And it turns out that when you combine a lot of spare time with a lot of surplus cash, people tend to get bored. And with modern technology and smartphones which make day trading stocks, an activity which was once limited to a very few, accessible to anybody who can spare $25, the resulting outcomes were things like GameStop rising by 4,500%, and the whole Wall Street bet speculation pump and dump scheme, and companies who are losing money having their stock prices double and triple, and the sheer number of new investors who came into the market in 2020 created a lot of competition, which then pushed up asset prices to record highs in the stock market, the housing market, commodities markets, and even the used car market as well, both here in the UK and in the USA as well. And while rising asset prices may on the surface appear to be a signal of a strong market and underlying economic growth and growth in wages and salaries and business profits, we need to take a deeper look into what it is that is actually fueling asset price growth. Because again, half of the world was in a recession, economic output fell dramatically in most countries. Many businesses and therefore jobs aren't going to come back, and yet still asset prices continue to boom. And the reason for this, or at least part of the reason, may be found in the fact that globally, interest rates were cut 207 times across the world by central banks. Meaning that whatever meager income you could have earned in the form of interest on savings a year ago had been completely wiped out. Certain countries actually took interest rates below zero, and these rate cuts were a massive disincentive for anybody holding cash in savings account to continue doing so. 0% rates are one thing, but when your bank starts to charge you for the privilege of lending them your hard-earned cash, that clearly marked a line for a lot of people, and this caused a lot of capital to flow into the asset markets in a very short period of time. I personally know a number of people who use their savings to invest into the stock market or real estate, and not necessarily because they have any particular interest in investing, but because they were angry at being charged or being barely compensated for holding money in easy access or savings accounts. And by the way, these aren't the only implications of cutting interest rates even further, and we have to understand that the value of an asset from an investment perspective is primarily governed by the available alternatives that the investor has. In the famous book The Intelligent Investor, called The Investing Bible by Warren Buffett, the author Ben Graham talks about stocks and bonds acting in equilibrium, and that an increase or decrease in the earning power of one will cause a relative shift in the value of the other because they are prime alternatives. You know, if the stock market is yielding 10% and bonds just 5%, eventually the market will rebalance itself to a more reasonable and rational state. But one thing that Ben Graham, or in fact any of the other great investors or economists, didn't really talk about was what would happen to the market if one or the other, either stocks or bonds, were to completely be destroyed as an asset class. And that's probably because they never conceived that interest rates could reach zero, let alone go negative. You know, common sense tells us that there is no incentive or reason to want to borrow money to strangers through the banking system for free. But nonetheless, here we are. And if you don't believe me that right now, for the most part, the bond market has been destroyed as a viable investment to the average investor, just take a look at the following numbers. Right now, the average 10-year US government bond is yielding around 1.4%, which isn't just a low figure, but in real inflation-adjusted terms, it's a negative figure, and one which is below the Federal Reserve target rate of inflation of 2%. And so on the one hand, you have a bond which guarantees you an average rate of interest of around 1.4%, and then on the other hand, a government target to devalue the currency which the bond is held in, namely dollars, by at least 2% per year. A figure which many, including myself, believe to have been massively exceeded given the level of quantitative easing that has taken place over the last year and a half. And then, on the other hand, we have corporate bonds, which are bonds issued by privately owned companies, and then they are rated in accordance with the financial strength of the company, the highest rating being a AAA. Now, there are two things which you should know about corporate bonds. The first is that they tend to yield better returns than government bonds simply because corporations are far more likely to become insolvent and therefore default on either payment of interest or repayment of principal than a government, especially the US government is. And the second thing to know, and something which those of you who have seen the movie The Big Short will understand, is that corporate bonds aren't always appraised properly, and sometimes a quality rating isn't actually very reflective of the true risk that the bondholder is taking on. But anyway, the average US AAA rated corporate bond is yielding around 2.8% right now. And once you subtract the target rate of inflation of 2% away from that figure, the average gross return in real terms is around 0.8%. And for that meager 0.8%, you have to take on the risk of default, which may be fairly low with financially strong companies, but it's still a risk. And then we have to take on the risk that inflation will exceed the target rate. It may also fall short of the target, leaving a larger gross profit. But actually, quantitative easing and its newfound popularity as an economic and political tool make it very likely that inflation will be higher than the target, not lower. And talking of inflation, another thing which makes right now a very dangerous time to be a new investor is the constant and seemingly endless growth in the supply of dollars and pounds, which of course devalues the purchasing power of each unit. In 1980, there were around $121 billion in circulation. There are now over 2 trillion. And the terrifying thing is, at the beginning of the year 2020, there was only around $1.8 trillion in circulation, meaning that there was a year-on-year increase of around 19.4%. Just take a minute to absorb that information. Nearly 1/5 of all dollars in circulation were created in 2020, and approximately the same number of dollars were added to the circulating supply in 2020 as between 1900 and 1987. And if there is one thing which above all else makes today a terrifying time to be a new investor, it's that figure, which illustrates that the growth in the circulating supply of dollars isn't just growing, but it seems to be growing exponentially. And this is primarily because quantitative easing, printing money, works so well politically for those in charge. You see, there are two ways to fund a government operation. The first being that you have to tax the money, and the second being that you print the money into existence. And of course that newly printed money gains its value by taking an equivalent amount of value away from the existing supply. And so one way or another people end up paying, whether it comes in the form of a raise in income or consumption tax, or whether you're paying 20 or 30% more for your groceries than this time last year because of inflation. But having said that, only when you fund a program through legitimate taxation do you have to raise taxes or reshuffle the deck in terms of who gets the funding. And in any case, you have to upset somebody. And of course, politically, in such a competitive environment, leaders have a massive incentive to want to upset the fewest number of voters possible. And it turns out that when you print money to fund government operations, especially when you're using that money to give it to people instead of them working, or to give it to companies when they're struggling, very few people care about the other costs involved, or even know that they exist. Now, as a new investor, this actually puts you between a rock and a hard place, because on the one hand, if interest rates continue on at near zero or even go negative, and printing money continues to become increasingly popular, which it has done over the last decade, then the value of stocks and the value of real estate and other commodities are likely to increase in value substantially. But if all of these things begin to cause substantial inflation, like the kind that we are seeing in the housing market across the world, and in the prices of stocks on average up by over 50% from the lows of last year, maybe raising interest rates, even though extremely unpopular, could be the only way to prevent a full-blown currency crisis and a complete destruction of the value of the dollar. And if rates do rise to historical averages of 10 or even 15%, then the value of stocks and real estate and all of these investment assets will have a long way to fall, as they are largely being propped up at the moment at record highs because of low rates, meaning that if interest rates are forced upward to prevent a currency crisis, we could see a few lost decades in the financial markets. And so the options are really one extreme or the other. But then again, holding cash is also an extremely dangerous undertaking because of inflation. I mean, the inflation in the supply of dollars just in 2020 was 20% in that year. And with a few more years like that, the value of dollars will have halved or done even worse. And to me, that's too much of a risk. And so with all of these factors in combination, and then considering that consumer trends are changing faster than ever, making businesses less predictable and harder to value, and that the political scene around the world is now geared toward higher taxation, more regulation, and higher mandatory wages, it's very hard to know where to invest your money, and every option seems to carry a substantial risk, including holding cash. And with all of these things in combination, I really do feel for new investors, as we are living through probably one of the toughest and most competitive periods for investment ever. Anyway, thanks for watching. If you enjoyed this video and you're interested in finance, investing, and business, we have a lot more content like this out weekly, so be sure to subscribe for those, and I'll see you in the next video.